something changed. And I'll tell you exactly what changed. Lower growth and higher rates, that's a deadly combination for the stock market. The fact that we've seen a breakdown is a clearest sign that the market finally gets the joke.
Are we back in an area where bad news is good news and good news is just nobody cares? Volatility is picking up across the board today on the 12th of February as stocks. The S&P 500 is down 1%, the Nasdaq's down 1.5%, gold's down 2.5%, which is a lot for the yellow metal in one trading day. Bitcoin is down 1%, back down to $65,000. And we're going to find out what's next. Is this the end of the AI trade? Are markets rotating into another asset? What's going to survive the coming storm? David Woo is joining us today. He's returning to give us his outlook for what's next for the markets and the economy. David Woo is the founder of David Woo Unbound. Check out his channel and his work, links down below. And previously, he was head of global rates and FX and emerging markets at the Bank of America. David, welcome back to the show. Last time we spoke, you were short the Nasdaq, where you maintained a bearish position. It's since basically traded sideways. A lot of volatility in the precious metals, which we can talk about. But are you selling stocks right now? We're at almost 7,000 points on the S&P not too long ago. It's now back down to 6,800, and people are concerned about uncertainty ahead. What's your take?
Yeah, I'm definitely a seller. I think I think last week for me was a huge week. In a sense that I sort of feel that something changed. And I'll tell you exactly what changed. If you think about this, right? We've been trading AI for much of the last 3 years, right? Since ChatGPT was launched, whatever it was in November 2022, the market has been trading AI. Recently people have been rotating out of AI into consumer, discretionary, staples, or industrials. But generally speaking, we're trading AI one with the other, right? The point here is this. In most of the last 3 years, okay, the AI trade has been driven by one thing, which is AI CapEx, right? Higher AI CapEx, higher the AI trade. That was the one correlation that was definitive. That was the hallmark of the entire AI trade, which was on the assumption, and there were two assumptions underpinning this positive correlation between the AI trade and AI CapEx, which is the idea that investors said, well, listen, surely the hyperscalers know better about the monetizability of AI than everybody else. And two, people figured that, the more money that these companies are going to be investing in AI is because they see higher expected return on investment. So all that is great and well and so on and so forth until basically this earnings season, because everything's changed. I don't have to tell you the big story. For me, the biggest story of the last month is the fact that investors have decided to punish, higher AI CapEx spending, whether it's Microsoft, Amazon, Google, whenever a company came up with a bigger, basically increase in guidance in terms of CapEx spending, the stock basically got smashed. And I think this is very, very important. This breakdown in the AI trade, AI CapEx correlation signals a fundamental, reassessment by the market about what AI is all about. And then it's something that I talked about in my last interview with you, which I think so far it's been validated, which is telling me the market understands that if companies are spending more on AI CapEx, it may be because everything that goes into building a data center is getting more expensive. So from that point of view, first of all, the fact that they're spending more doesn't mean that they're going to be getting more. In fact, they could very well be getting less. The second thing is that markets are starting to understand that the CapEx spending made by the hyperscalers is not out of greed, but out of fear. Actually, it's not that they necessarily see a pot of gold at the end of the rainbow, but rather they think if there is a pot of gold there, that they will be a big loser unless they're the first one to get there. So from that point of view, I think the way the market's been trading tells me that the AI trade is in trouble, especially given the fact, I have to tell you, since October, the AI trade's gone nowhere. Nasdaq has been flat. And in fact, this has actually happened 3 other times since since 2020, which is after a surge, the market goes sideways for a while. And guess what? In all 3 instances, the AI trade blew up, or rather Nasdaq corrected, And then, so from that point of view, I sort of feel like, the market is in trouble and it's difficult for the market to go higher. And if it cannot go higher, it can only go lower.
Why is it difficult for
what we're going into now.
Difficult for the market to go higher? Because earnings are going to be reduced. Why valuations are stretched? Why?
If you look at actually just the earnings story, I mean, if you think about even if you just look at the combined, we haven't gotten the NVIDIA numbers yet, but if you look at the other Magnificent Seven, if you look at their earnings growth year on year, and then take a 4-quarter moving average just to smooth out the volatility, guess what? It's slowing. It's been slowing for a while. So from that point of view, not only the momentum behind the AI trade is slowing, but earnings growth is slowing. And I just told you, if higher CapEx doesn't do the trick, if markets now sees higher CapEx as a problem for AI trade, then guess what? What are you going to be trading on? Because there is no question that revenue is not picking up. And this is the big story. The big story, what we discover now is that, the fact that OpenAI wants to now basically show ads in ChatGPT, something that Sam Altman said that he hated, the idea that he hated only 2 years ago, tells me that clearly OpenAI is struggling to ramp up paid subscription. That's the bottom line. The bottom line here is that, the revenue growth at these places remain very slow. And, because guess what? Because the free version of AI is getting better and better. And there is no better free version of AI than, guess what? The AI mode in Google search, which practically does everything most people need from AI anyway. So I think from that point of view, this is going to get very interesting because actually OpenAI, by starting to show ads, this is what started this week, right? That's the big story this week, that OpenAI is starting to show ads in ChatGPT. That means that they're now going after the advertising revenue of Google, which accounts for 70% to 75% of Google's basically total revenue. But what do you think Google is going to do? Google is going to say, you know what, let's make the free version of AI even better, which is going to further cannibalize the ability of OpenAI to actually pick up subscription. So what I'm telling you is that the coming battle over digital ads is going to be a big AI killer because nobody's going to make any money, which has been my premise all along.
Before we continue with the video, I want to talk about a very interesting gold company. Today's sponsor, Heliostar Metals, a Mexican gold producer targeting 500,000 ounces of gold per year by the end of the decade. Heliostar Metals is building the next mid-tier gold producer with a clear strategy focused on speed, grade, and growth. Operating 2 producing mines and advancing a fully owned pipeline of high-quality development assets in Mexico, Heliostar offers investors a compelling blend of near-term cash flow and substantial long-term upside. This rare combination results in the potential to fund growth while limiting dilution. The company has 2 operating mines, La Colorada and San Agustin, which are driving current cash flow, with recent restarts, mine life extensions, and expansion approvals all supporting a strong production profile through 2026 and beyond. 3 advanced development projects provide clear visibility to growth, led by the high-grade Ana Paula project, targeting first production in 2028, with average output of roughly 101,000 ounces a year at an estimated all-in sustaining cost of US $1,011 per ounce. Serra de Gallo, a gold-silver open-pit heap leach project, is supported by a December 2025 preliminary feasibility study outlining a 15-year mine life producing roughly 86,000 ounces per year at an all-in cost of $1,390 per gold equivalent ounces. Near-term milestones include production ramp-ups, feasibility studies, permitting progress, and ongoing drill results across operating mines and Ana Paula, each with the potential to materially re-rate the company's valuation. With a fully owned asset base, strong operational momentum, and a robust pipeline of growth projects, the company is positioned to evolve into a multi-billion-dollar gold producer. Learn more about the company by clicking on the link in the description down below or scan the QR code here. Interesting. Maybe there could just be a simple market rotation right now happening. This is an article from CNBC published last week, David. Market rotation investors are selling 21st century innovators to buy 19th century businesses. Basically, the summary of this video, with this article rather, is that there's a rotation from high-tech companies into materials, industrials, and miners. And if we take a look at what's been happening with the IYM, which is the iShares Materials ETF, that's up about, well, let's just take year to date. That's up 19% year to date versus the NASDAQ's negative 2.28. And let's just compare GDX, which is the VanEck Gold Miners ETF. I don't have to tell you how well gold's done. That's up another 18% as well. And, markets are up, but some markets more than others. And this is one example. David, what do you think about this rotation?
I think, let me tell you this. This rotation, in my view, is definitely, I think it's literally like, I'm fading it as well. And I'll tell you why. Okay. What is the rotation? The rotation that we've, if you look at the best performing sectors and assets year to date, what? We're talking about small cap, Russell 2000, high yield credit, okay? You're looking at whatever, copper, industrial metals. You're looking at EM equities. They've done extremely well. I mean, let me tell you this. All these sectors, all these markets are what I call early cycle winners, right? These happen to be very high beta growth proxies that tend to do well at the beginning of an economic expansion. Let me tell you, we can debate where we are in the business cycle right now. The only question is how late we are in the cycle. So why are people suddenly piling into early cycle winners? I think there's only one very straightforward explanation. Because everybody thinks that Donald Trump, because we're approaching a midterm election, that Trump is going to throw the kitchen sink at the economy and that we're going to get more stimulus. What the market doesn't get, and perhaps only slowly now, is that, you know what? Yeah, Warsh is Trump's second choice. You know why? Why did Trump go with Warsh in the end as opposed to Hassett? Because Trump understands that he cannot bend the Federal Reserve to his will. And why is that? Because Trump's greatest fear, what keeps him up at night from sleeping, is the possibility that Jerome Powell might end up staying on at the Fed after his chairmanship expires in May. In fact, my bet remains that actually there's a very good chance that Jerome Powell's going to stay on even, with the Warsh. And I think the point here is this. Just think about this for a moment. Powell, if he were to, his governorship does not expire until 2028. He has a free option. He could leave after 1 month, 3 months, 6 months. He's not in a hurry. Moreover, he knows that the day he leaves, Trump is going to replace him with a super dove. In other words, do you think Powell wants to go into the history book as the chairman of the Federal Reserve who handed over the key of the Federal Reserve to Donald Trump? Are you kidding me? So what I'm telling you is that I think what is going on here is that the market is starting to realize that, Trump is not going to be able to get his way as has been widely expected, because he's facing constraint at the Fed. He's also facing constraint at the Supreme Court. The fact is that the Supreme Court so far has not ruled on the legality of his tariffs. And for all I know, the Supreme Court might decide to sit on it for the next 3 months. And then what? Which will basically make it impossible for the Fed, for Trump to go down the path of sending out a $2,000, whatever tariff rebate to every American. So what I'm saying is that the market, the growth-sensitive markets have done very well this year because people figured that Donald Trump is going to once again do what he always does, which is to basically deliver more stimulus, and then the economy is going to surprise to the upside. And I think the market doesn't get is that Trump is facing enormous constraints, both vis-a-vis the Fed as well as the Supreme Court, and increasingly, possibly even in Congress, because you just saw that the 6 Republicans voted with Democrats to actually to overturn his tariff against Canada. So this is a reality, then I think the market is overestimating what Trump is going to be able to do in 2026.
Well, if it's overturned, isn't that good news for the market? We have a president now. Literally, meaning we have an event that shows us that we have, he doesn't have unilateral power to do whatever he wants. And so maybe trade barriers will be reduced, not increased this year. What do you think?
I think, first of all, the fact that they voted, basically, that this bill passed Congress, it's going to get through the Senate and the House, by the way. Okay, to repeal the tariff on Canada, but Trump is going to veto it. I mean, let me tell you this, because I mean, in order to override Trump's veto, you need two-thirds majority in the Senate, which is unlikely. So from that point of view, it just tells you that the whole thing is a mess. The whole thing is a mess to the extent that Trump is not going to. What the most important thing is, again, the only fiscal stimulus Trump can possibly do in 2026 is, again, say, well, you know, I collected $200 billion in tariff revenue last year. I'm now going to send it to, I'm going to send a $2,000 check to everybody making less than $75,000. Let me tell you this, given the congressional vote yesterday, it's becoming extremely clear that this is never going to go anywhere. This will never take off. So from that point of view, the important thing is to know it's not that so much that the tariff is going to get canceled, but rather that the scope for additional stimulus this year is one big zero at the moment.
Well, let me just give you some economic data. Starting with ISM manufacturing, PMI jumped to 52.6. This is the first expansionary reading in 2 years. Above 50 is expansionary. Perhaps that is a leading indicator for an economic expansion.
Listen, I think, that's one number, but I don't disagree. I think, it's been depressed for some time. So like inventory has been drawn down. So naturally you would expect at the start of the year that orders are going up. And by the way, what makes this very interesting is what happens tomorrow with the CPI data. Because, as the Fed has been telling us, and we've been hearing from industry observers, which is that a lot of companies are going to take advantage of January to raise prices. And then you raise prices when you restock inventory. So it is very likely, in my view, it's very plausible that the strong new orders uptick in ISM manufacturing could very well reflect, essentially the restocking and guess what? Repricing of based on the tariff. So I actually think that, I think maybe this is what's happening today, which is the stock market is down today because people are a bit nervous about the CPI number tomorrow. And I think, and then we could actually see an increased line of pass-through of tariff into U.S. inflation, which will be deadly for the stock market, obviously.
Stock market doesn't seem to care about the fact that the jobs market just had a huge landmark number, 130,000 jobs added in January, beating expectations across the board. Yet stocks are down. Are we back in an area where bad news is good news and good news is just nobody cares?
No, I think it's even that. It's because the makeup. I mean, I want to see strong numbers, believe me. But if I look at yesterday's number, it's a total joke, right? So what it says is this. So all of last year, the U.S. economy created 185,000 jobs. But in January, we basically created 135,000 jobs. I mean, so that in itself, so what happened in January that all of a sudden you saw the surge? Moreover, out of the 85,000 jobs came from healthcare, right? And then on top of the 85,000 jobs, 50,000 of those jobs are basically people, essentially the caretakers for elderly people, which are probably not very high-paying jobs to begin with. But what it basically says is that this is a pretty sick economy. Sick economy in the sense that, you're talking about a lot of people being hired to look after elderly people who are sick, who need basic care of. And this does not, give you any sense of a sort of a dynamic nature of this. Yeah, we know that, elderly people, like 80% of US household wealth is held by people over the age of 55. And that's what's going on. So the stock market went up last year, house prices up as a result, like older people who are, going to retirement or hiring more people to look after them. That's what's really going on. There hasn't been much else. Right. And the fact is that manufacturing employment, just look at the manufacturing employment. It looks terrible.
Take a look at what Peter Navarro, trade advisor, has to say about the jobs market. He said this before the report came out this week, by the way.
No, the jobs report's going to come out tomorrow. Yeah. We have to revise our expectations down significantly for what a monthly job number should look like. When we were letting in 2 million illegal aliens, they're coming in. We had to produce 200,000 jobs a month for steady state. And by the way, all of the jobs that we were creating in Biden years were going to illegals. Americans were going to the unemployment lines. That's totally reversed. And now 50,000 a month is going to be more like what we need. So Wall Street, when this stuff comes out, they can't rain on that parade. They have to adjust for the fact that we're deporting millions of illegals.
That's a good.
Okay, what do you think about that?
I think what he's actually saying is about the most bearish, basically, story for the entire US stock market. Because think about it this way, right? What it's basically saying is that, you know what? Even though the economy is not producing that many jobs, the labor market is actually very tight. You know, job is a driver of economic growth. We're not going to get that much growth, but guess what? The unemployment is going to be low. So as a result, the Fed is actually not going to be able to cut rates. What it's basically saying is that real rates are going to be higher as a result of the deportation by Donald J. Trump. And that's what it means. So what it basically means that we're going to, that's what it actually means. It just means that if you're going to have, you know, fewer illegals entering the U.S. and more people actually being deported, and 2.5 million people left the countries last year, the illegals. What it basically means is that you're not going to get a lot of growth, but at the same time, you're not going to basically, there's not going to be so much slack in the economy that will allow the Fed to justify cutting rates. So lower growth and higher rates, you know, that's a deadly combination for the stock market, no?
Well, what do you think the Fed's going to do? How dovish or hawkish is Warsh actually going to be? People have been saying that he's probably the most hawkish of all the other Fed nomination candidates.
Listen, I think Trump appointed Warsh in order to pressure Jerome Powell to leave after his tenure expires. But my the view is that Jerome Powell is not an idiot. He does not want to turn the key over to Trump. And he knows that as soon as he leaves, he's going to be replaced by a super dove, which will give the Trump appointees a majority on the board. So to begin with, this is what. Secondly, I would even argue if I were Warsh, I don't even really want, you know, Powell to leave either. Actually, this is a great irony. You know what? If I were Warsh, I actually want Powell to stay. Because if Powell were to leave, you know, I'm going to be getting a phone call every day from Trump saying that, why haven't you already cut rates? But if Powell were to stay on, you know, if you're Warsh, you could always blame it on Powell, saying that, well, the guy is still sticking around. There's not much I can do. So the bottom line here is this. I think Warsh actually, I think we might end up with a situation where both Warsh and Powell end up staying, and that actually overall, the Fed actually takes on a more hawkish bias. But let me just tell you this. I happen to have a lot of respect for Warsh, only because Warsh has been one of the most consistent person who's been jockeying for this job for the last 20 years, which is that he believes, okay, that, you know, when the Fed engages in QE forever, when it blows up its balance sheet, it loses its independence by definition. Because the more you blow up your balance sheet, the more, you know, politicians expect you to buy more government bonds down the road. That's the reason why Warsh is completely against, okay, big balance sheet, because he actually does believe in Fed independence. So I think the market doesn't get it. What this guy wants, he's want a smaller Fed balance sheet, and he's willing to lower short-term interest rates to offset any increase in long-term real interest rates. And I think from that point of view, that makes a lot of sense to me, but that's definitely not bullish for the stock market.
There's been rumors that I read a line that Kevin Warsh may actually double down on bond purchases, especially mortgage-backed securities. That is basically QE. The Fed already, starting December, announced, I think, a $40 billion a month program, something like that. I mean, that is probably more significant. Yeah, go ahead.
I think the only thing Warsh might do, he's just going to say, well, you know, listen, in the future, he doesn't want to buy any treasuries. He could consider buying mortgage bonds, but he'll be buying fewer treasuries. But I think it's even there is very unlikely right away. Yeah, if the AI bubble bursts and the AI crashes and we go into a massive recession, sure. I mean, anybody, whether it's Warsh or anybody else, will be going back to doing QE because there will be nothing else. But in that kind of situation, I imagine he'd be buying more MBS than buying US treasuries. And I imagine in the first basically get-go, he'll be buying more short data stuff as opposed to long data stuff. So I think it's one of these things that, you know, like right now it's you know, who knows what is going to happen, because again, I mean, like, you know, Warsh just like everybody else. I don't want to sit here and speculate. What I know is that he is not going to do Trump's bidding insofar that he's not going to come in and start cutting rates, not only because he's not that guy, but also because he is just one guy. He has the same vote as anybody else. And then I think, you know, and I think from that point of view, I think the market needs to be very, very careful not to think that the Fed is going to, that the Fed is definitely like if anything, the more that the Trump pushes, the more the Fed is going to be holding back. And this is what the market, again, I think the market gives Trump too much credit. I agree. Last year, he got his way on a lot of different things. But 2026, in my view, is a very different proposition.
Okay, I want to talk about gold and then finish off on the stock market one more time. There's a lot of AI news that I want to just get your, a few AI news that I want to get your take on. This is a video that you published on your own channel, David Woo Unbound. Again, please check out David Woo Unbound. He's got a great YouTube channel. You commented on the 1st of February when this video came out, or January 31st rather, that gold is the only true portfolio hedge in the post-rule-based order era. Okay, gold's up to, it went up to $5,500 at one point. It's down 20%. So comment on that view. Do you still hold that view after the correction on February 3rd?
Absolutely, I hold that. I hold that view, very strongly. In fact, because I mean, there's a sort of the short-term part and there's the long-term part. The short-term part is very simple. By the way, because one of the if you look at, and I think we talked about this the last time we spoke, which is that the only gold correlation that has not broken down over the past year is the gold equity correlation, right? Like, it's pretty amazing. Over the past year, it's like, well, higher stocks means higher gold prices. Why is that? Because you know what? Because to me, it basically shows the increased involvement of the retail investor, in the market. And retail investor, what do they buy? They buy stocks and they buy gold. So from that point of view, as stocks went up, they had more money to spend, they felt wealthier, they bought more gold. And I think from that point of view, I think if the stock market does crash, I do think gold could very well go down with stocks in the short term, simply because margin calls, that kind of thing, that's just going to be the nature of the beast. However, I have no doubt that central banks will be coming and scooping up gold at lower levels possibly, but definitely that's what's going to actually happen. By the way, you know what? The most interesting story I've heard all month is the fact that the CEO of Amundi is like the BlackRock of Europe. CEO of Amundi came out and said they're going to start reducing their holdings of U.S. assets in 2026. That to me is amazing. That is like, wow. That's like, Larry Fink coming out saying that we're going to be basically buying gold, a lot of gold. It's the same thing. Because what I'm saying to you is that this is the first recognition by one of the most important persons in Europe when it comes to European investments. Because I don't tell you, a third of U.S. treasuries are held by foreigners in Europe. Like what? 60% of their, of European pension funds, their assets sitting in the U.S. If Amundi decides to go down this path, believe me, a lot of other European investors are going to be heading the same direction. And the reason why they're doing this is because they think this is the end of the rule-based order. They think that if Trump tomorrow wants to basically take Greenland, the next day Trump can basically default on all U.S. treasuries owed to foreign investors. So as a result, what is going on here is that what people don't realize is the damage, the extent of the damage to confidence that's actually happened over the last 6 weeks as a result of a confluence of geopolitical events that has really, I think, now it's no longer going to be the Chinese buying gold, selling dollar. I think the Europeans are going to be following their lead actually shortly after.
Let me just ask you this from a, chart perspective. Let's say I know nothing about gold. I'm just looking at the charts. I know nothing about the geopolitics and the fundamentals that may drive the gold price higher. And I'm just looking at what gold has done in the past. And in the past two bull cycles, when gold has peaked in 2011 and 1980, gold has fallen very shortly after by the order of 20 to 40%, flatline, then fell another 50 to 60%. That's just the pattern of the last two bull cycles. It's doing exactly the first part of this pattern here, which is to fall 20%, and it's repeating what it looks like it's doing in 1980 and then 2011. And so my question is, why would you invest in an asset? We're looking to invest in an asset that's looking at repeating another 60% fall, which is what happened the last two times.
Wouldn't be, as I said, I wouldn't be buying gold here.
Okay.
For the same reason, because I said before, like gold is trading with stocks. If stocks go down, so will gold. However, I do think that at a certain point, I would say 4,000 or even 4,000. I think 4,500 is, and I've said this, on Bloomberg recently, at 4,500, I think gold becomes very attractive. I think, level to basically get back into. I think, if, and it's certainly between 4,000 and 4,500. I'll be very, very surprised if gold gets below 4,000. Okay. That's my view. Because at the end of the day, the way we're going to think about this is very simple. Okay. Now, if you think about this, right, at the start, this is why the whole rule-based order, if indeed we are, the rule-based, basically international order era is ending. What does that really mean? Because before the rule-based international order was firmly established, let's just take it, the beginning of the 1960s, 60% of central bank holdings were in gold. Reserve holdings were in gold.
Yeah.
Right now, you're talking about 15%. If we would just go back to halfway there, gold is going to be much higher. This is what I'm saying to you that, I think, this is what it really, I think, comes down to, which is that I think, unless you, it's not even unless, because I'm fairly certain that the rule-based order is dead as dodo. The dodo right now, because I think, it is very clear that Trump is doubling down, and that's what it is.
Do you have similar views on Bitcoin?
Yeah, I'm
you
sure
do on
Bitcoin.
gold?
I think Bitcoin is finished. Listen, let me just put it this way. Actually, I want to say it's finished. I do think Trump is going to throw, listen, and I've been saying this for a while, that Trump doesn't give a damn about Bitcoin. He cares mainly about stable coins, and he got the Genius Act through. The way he looks at stablecoin is that stablecoin is a digital extension of the US dollar. So in that sense, promoting stablecoin pegged to the US dollar is like promoting US dollar hegemony. It's obvious for the President of the United States. At the same time, stablecoins have to be backed by US Treasuries. So stablecoin also become a potential huge buyer of US Treasuries. So this is why Trump cares about stablecoin for the same reason he doesn't give a damn about Bitcoin. The only question nowadays is when will Trump throw a lifeline to Bitcoin? That's the only question. I don't think it's at this level. I think it's probably closer to 50,000. So I will be looking to take profit on my short Bitcoin position, probably around 55.
Let's finish off on some tech news like I mentioned earlier. Now, here is something interesting that popped up recently. Anthropic. Okay, Anthropic's new AI tool sends shudders through the software stocks. This was early February, wiping out basically billions, if not trillions, of market cap in software stocks, right? Claude Coworker is meant to be like an AI colleague with the ability to read files, organize folders, and draft documents on your behalf. This essentially will wipe out a lot of other software services overnight. I guess the question is, among tech and software, there's probably a mini rotation happening now. Which side would you be on?
Listen, I do think, I think on the software side, I don't like any of them, by the way. But okay. I do think that, obviously a lot of people have said the same thing, which is that, you cannot wipe out all of software, SAS, basically vendors, overnight. And then, businesses, not all businesses are willing to basically trying to reinvent the wheel, right? Because what they're suggesting is that Anthropic is going to help you, okay, essentially rebuild your entire software infrastructure so that you no longer have to pay monthly fees to the guys you're basically
I understand that from a fundamental perspective. I understand what you're trying to say, but I think investors are not really taking it that way. See, like this paragraph, for example, jury's still out whether or not AI is going to wipe out, the software industry, but investors were spooked on Tuesday, early February, selling off shares in legal and financial software. So as soon as something like this comes out, people's first instinct is to sell. And I'm looking at this news and I'm thinking, well, I don't know what's next. I don't know what AI agent is going to be released next, and I don't know which industry is going to be affected next. Why not just sell everything? I think maybe the mentality of people right now.
That's my view. This is why I'm short NASDAQ. That's the great, because I'm short everything. Okay, the entire tech universe. So from that point of view, I'm not taking. I don't want to take any sector risk right now. Do I think that you want to be long the chip makers because they're the enablers and so on and so forth? I think actually when the music stops, I think there'll be no place to hide. And that is very clear to me.
Going back to earnings, though, we're seeing AMD, for example, last week, it beat earnings expectations. It's still down 17% after a pretty good revenue report. Why? I
think a lot of people are starting to realize, first of all, the competition is intensifying, which is basically a margin issue. And I think Rubin is a very good, I mean, by the way, you remember AMD and Intel, a very, very big part of their business is still selling basically processors for PCs. And guess what? That business is getting completely screwed. By what? By AI. Because what AI is doing is driving up the prices of memory chips. And then you realize, right now, I'm actually being told, basically, I was just at a computer store yesterday, and the guy was telling me, you got to basically buy a new computer right now before prices go through the roof. Because given how much, RAM prices, memory prices have gone up year to date, they're saying now that 45% of the cost of making a PC is now actually the memory price. And this is going to be deadly. That means they're going to be selling fewer PCs, which is going to obviously be bad news for the likes of Intel and AMD. And this is I think, a very important reason why these stocks basically are starting to struggle. I especially don't like Intel.
And then finally, I want to talk about AI CapEx. Some would say that AI CapEx has been the primary driver of valuations in the last year. And, companies investing in each other. So Amazon just announced a $200 billion CapEx project or expenditure this year. The analysts were expecting only $146 billion, so that is beating expectations. It expects CapEx to continue to climb higher this year as it aggressively invests in data centers and other infrastructure to meet a surge in AI demand. That's what the article says. David, are they going to realize a high enough ROI to justify this?
Of course not, because it has nothing to do with ROI. Right now, this is the reality. The reality of these guys, whether it's Microsoft or Google or Amazon, they're investing in AI and data centers only because if each individual company feels like if they were to pull back, that would simply allow the others to increase their market share, which they cannot afford to do. This is a classic prisoner's dilemma problem. This is why this whole entire investment thing is not about ROI. It's about essentially market share. And as a result, this is why the market's starting to wake up to the reality. That's what I said at the very outset of the interview. The fact that we've seen a breakdown in terms of the correlation between the AI trade and AI CapEx is a clearest sign that the market finally gets the joke. That more CapEx doesn't necessarily mean basically higher return on investment. In fact, it probably means the opposite.
So because they're still investing though, that probably means they'll prop up other company stocks or perhaps their own stocks. Can we look at it that way?
I don't think their own stock. I mean, because now people realize that, well, if these companies don't care about ROI and they're pouring all this money that may not have generate any returns down the road, the stock is going to go down. That much is very clear. I mean, Amazon is a great story. I mean, they revised up their CapEx basically forecast, and the stock got absolutely hammered. And I think the market understands that now. Yeah, this is the reason why people are piling into Micron, my Samsung Hynix, the high memory chips guys, because they say, oh, wow, let's at least basically make money some other ways. But I do think that at this point, I don't know if this music won't stop. As Chuck Prince famously said back in 2007, just before the subprime crisis erupted, that as long as the music is playing, you still have to go on dancing. I don't know what's going to cause the music to stop. But all I know is that when it does, there will be no place to hide. And especially if you look at the semiconductor cycle, in 3 months' time, this will be the longest semiconductor cycle ever in U.S. history. And that is very worrying.
But finally, do you think Chinese tech companies are anywhere close to posing a risk for U.S. companies from an investor's perspective, in the sense that they will considerably start eating up market share? I'm not even talking about just DeepSeek, right? That's old news. I'm talking about overall consumers in the U.S. will start using more Chinese companies away from U.S. ones. Are we there yet?
I think we're getting very close. In fact, last week there was a major report that of all players, Dell Computer is now talking to the Chinese about sourcing their DRAM chips from China. That is fascinating because right now, because of the shortage in capacity, Samsung, Hynix, Micron, prices of DRAM, I told you, is going through the roof, and there's just not enough of it to go around in the world. And this is why Dell is now going to the Chinese and say, would you be willing to sell me some chips? And this is actually going to allow the Chinese to break into this area that the Chinese have probably a very decent chance of break into. By the way, right now, out of the top 5 basically memory chip makers, one of them is already Chinese. And then at the rate at which the Chinese are throwing money into expanding their capacity, I think it's reasonable to think that maybe within 2 to 3 years, maybe half of them will be Chinese. And this is going to get very interesting because this is one area the Chinese can definitely dominate. It's much easier than the AI chips. Okay, from that point of view.
All right. So your highest confidence trade for the next couple months?
Sell NASDAQ. Okay, I'm short NASDAQ and long Nifty 50. I love the India story. I think India is an amazing story. It's the fastest growing economy in the world. The stock market has been the worst performing in 2025. We just got a trade deal between the US and India. Yeah. I'm very bullish on India. So I love the story of India also because India has lost out to the AI trade. All the Asia money has been pouring into South Korea, Taiwan, chasing after the AI trade. That's why India's underperformed. So this is why, for me, if you really believe that the AI trade, is if not about to burst, at least a stalling, I would think that India is a great way to position for this stalling AI trade.
Okay, excellent. David, thank you so much. Tell us where we can find your work.
So first of all, I just want to say I've got a book coming out. They'll be published in the U.S. next month on March 31st. Merry-Go-Round Broke Down. It's a novel about globalization. And it's gotten amazing, basically, reviews already and endorsement by some of the biggest names. It's really my attempt at trying to make globalization accessible to everybody, regardless their levels. So it's more than just about investing. It's a way to look at the world. And then I want to sort of take the whole debate about globalization directly to the general public. So check that out. The book is already available for pre-order on Amazon, on Walmart, Barnes and Nobles. But you do have to basically buy it in the U.S. Right now, it's only for distribution in the U.S. We're negotiating with several other countries right now about book rights and maybe even movie rights. But check that out if you're interested in my investment strategy. Of course, check out my YouTube channel, or for that matter, my retail website, davidwoounbound.com.
Okay. We'll put the links down below, so make sure to follow David Woo and David Woo Unbound. Pleasure to host you once more, David. Welcome back, and hope to see you again soon. Take care for now.
Great. Thank you, David.
Thank you for watching. Don't forget to like and subscribe.